What is your market outlook for FY21?
At any given point in time, when we actually look at market outlook, we look at it from 3 or 4 perspectives. One is global context, how's global context, and that is critical because in India, actually FIs own $300 billion of $300-400 billion of shareholding. They own 22% of your BSE 200. So how they are looking at your country becomes critical. Second is domestic growth. How's the domestic growth? Third and most critical is how the earnings are panning out, because that's where the portfolio construction happens, and that's most critical. And fourth is valuation, how valuations are. So coming to first, there are 3 key trends which over last 6 months have turned constructive from global perspective. One, there has been first phase of trade settlement between US and China. At the margin, it means more trade activity, so it's good. At least incrementally you have one less thing to worry about, and at the margin it will also increase the trade between US, China, and invariably across other geographies. Second is, and which is more flow related, that till around November, December 18, there was a hope that there will be interest rate tightening by global central banks. That has complete with the moderation of growth in those developed market, it has become upside down. Over last 9 months, you have seen expansion of balance sheets and interest rates cut from US and other developed market central banks, and that augurs well from risk assets, be it commodities or be it emerging markets, and that has helped. So if you look at last 3.5-4 months number in terms of FI flows, we have got $7 billion of FI flows. The Nifty growth this year would be around 10%. Next year it is likely to be much higher, and next year's higher earnings growth is mainly driven by financials. All these Axis, ICICI, SBI, all these financials who are running huge credit cost, and they were not making profits for several of past years, or very low profit for several of last few years, have started turning around. So as they turn around and their profitability returns to a normalized level, just to put it in perspective, Axis, ICICI and SBI put together have a asset book of loan advances book of about 35 lakh crore rupees, 35-40 lakh crore rupees. Even 1% ROA on that, or 1.5% ROA on that, means anywhere between 40 to 60,000 crore rupees of profit. And probably in 18 they made losses. So that is the kind of delta, and that's why you see Nifty earnings growth far superior. So incremental Nifty earnings growth majorly will be contributed by financials next year. So that's why that 16.8 to 18% number for next year.
Which are the sectors that you're currently bullish on?
Financials is very natural because of 2 things in financials. One is there is a huge opportunity. Credit to GDP is very low, so that organic growth of credit in the system will keep on happening anywhere. Lately it has been very low, but will keep on happening at anywhere between 8% to 12%. Second is, on top of that, you have PSUs who are still probably 40%, 50% of incremental credit, and 60-65% of the overall outstanding loans in the system. So you have rest of the guys, private sector guys, who are gaining market share, and that's where largely the weight is, rather than PSU banks. So that's another thing. So you have 2 things, that you have organic growth opportunity, and you have market share gain opportunity for private sector guys, private sector financials. And then you have these private sector financials where the managements have been good, their liability franchise have shaped up very well, and they are not capital starved. Capital is in abundance. So just to give you an example, lately Bajaj Finance went to raise 8,000 crore rupees and they got bid of 40,000 crore rupees. So this abundance of capital that is available for these guys because of the kind of delivery that they had for several years. So that's one part of financials, which is banks. Second part of financials is actually your insurance companies. So all the companies who are beneficiary of increasing financialization of savings, and it is not going to actually reduce over a period of time. It is only going to go up, financialization of savings. So there we are actually betting on insurance companies, both general and life insurance companies, and AMCs. A few of the AMCs are there in portfolio. So these are the 2. So if you put together, it's banks who are beneficiary of weaker competition and huge opportunity, and insurance companies and other financial saving proxies, which are again beneficiaries of weaker competition and huge growth runway that is there in these companies.
Which sectors are you currently keeping an eye on?
You have FMCG, where again our focus is far more on companies where growth is good, but as compared to FMCG, we are relatively more constructive on consumer durables, retail, those kind of names, which is basically your Titans of the world, Batas of the world, your Avenues of the world, your Whirlpools. So consumer durable and retail, these are the two pieces of consumer part which are relatively more constructive as at this point in time. Although in the past FMCG was a much larger weight, we have reduced weight in FMCG over last 6-8 months a year based on valuation, moderation of growth. To some extent IT and FMCG also now at this point in time, although their underlying business characteristics are very good, they generate a lot of free cash and their clean balance sheets. Its portfolio is like a team, so you need it's like a football team, certain players who actually attack and create goals, so they create a lot of alpha, and if the thesis don't play out, it has been a very volatile time. From macroeconomic perspective, so you also need players who will defend. So whenever things go bad, you also need portfolio sectors and companies who will outperform on downside in a big manner. So it's a combination of attack and defense. So IT actually falls more on defense side, dividend yield, and steady probably 8-10% return rather than creating alpha.
Which sectors would you avoid?
We don't necessarily avoid per se, but we typically have stayed either meaningful underweight or out of a lot of these PSU banks. So that's one space. US Generic is another space where, although we keep on looking at it because they were great companies, but the context is not turning. For that is another space where we are underweight. These are the two spaces I think where we are underweight, I think.
What have been some of the important learnings through your career?
The biggest advantage that the money managers who start their career with research is that they have themselves done the Excel sheets, and then they themselves have done the business modeling. How it helps over a period of time is that by just looking at the numbers, you can get those trends much faster as compared to a money manager or a person who would have directly joined buy side and not done sales side institutional research. So that is one clear advantage. Second lesson, and that is more critical from business perspective or money management perspective, that I have actually learned being a capital goods and infrastructure sector, is that what businesses should not be like, what kind of businesses actually create wealth, and what are those drivers for creating wealth. So just to actually stretch it a little bit, capital goods, infrastructure, the businesses where you deal with governments and the businesses where your cash flows are weak, the businesses which are not capital efficient, typically they are more cyclical, they are more tactical, they create some money for 1 or 2 years, but you can't create wealth out of them. And that was the biggest lesson that I learned by tracking those sectors, that the characteristics of the businesses should be capital efficient business, huge business opportunity, and able management, and high ROC. These are the businesses which actually over a period of time create wealth, and that's what has shaped the quality bias that I have today, which the foundation was laid actually initially by doing exactly opposite sectors in terms of coverage.
An investor or mutual fund manager you admire?
Charlie Munger and Warren Buffett are two names which I admire the most, and the core reason why I admire them is they were the first guys who actually appreciated the change in the way you should value businesses and the kind of businesses you should value, because before that most of the people tend to just look at the asset valuation. Just to put an example, like there is a ABC company that has 100 rupees of fixed assets. If it is available at 50, people used to buy it and trade till 100 rupees and then sell it. That was the core thought process back then. These were the first guys who came and said, okay, that's one part of it, but the wealth creation or compounding actually happens in businesses where goodwill, brands, or some regulatory advantage, some form of competitive advantage or moat actually drives the earnings rather than just your asset base. And those are the businesses which compound money rather than one time 50 to 100 rupees. I think that thought process to a great extent, these were one of the few first initial guys who actually brought in that thought process, and that's why actually I appreciate them so much.